Indian markets seeing volatility at the start of 2024. Today we try to understand how and why Indian investors should diversify their investments into global markets to hedge themselves from the volatile Indian equity markets in 2024. This is Smart Money, and today we're going to talk about the big learnings from recent bear markets and how do you structure your global investments. Devina, Mehra, the founder, chairperson and managing director of First Global, is joining us on Smart Money today. Devina, thank you so much for being here with us on the show. It's been a while since we spoke to you, and the markets, right? The markets have been terrific since we spoke last.
Thanks, Sonia, for having me, and always a pleasure to talk to you. Yes, but I mean, the markets have been up and down and overall up, which is what I expected. But then when we talk of global diversification, it is not from a one-year perspective. It is not as if that we expect Indian markets to underperform for 2024, and therefore we should look at global markets. The global diversification theme in your portfolio has to be a more long-term thing, that over a period of time, you have a significant portion of your portfolio outside India as well.
You know, since you primarily sit outside India, you have a better viewpoint on how things are panning out, right? Investors in India generally tend to be attracted to that familiarity bias. I know the Indian market, so I invest here. So for those people who are perhaps looking to invest in global markets, why should I put my money in global markets if India is amongst the fastest growing economies in the world?
Yes, I get this question all the time, Sonia, that if India is the, or at least one of the fastest growing economies in the world, why should I look elsewhere? And let me take you back 25 years. And in the 1990s, which were the fastest growing economies in the world? They were the Asian tigers. The Southeast Asian countries were termed the Asian tigers simply because they were growing at those stupendous growth rates. And yet, almost little over 25 years ago, there was something called an Asian crisis. So the younger generation could probably Google that. And in just 1 year, all those markets, between the market and the currency, fell between 50% to 90%. 50% for Taiwan, 90% for Indonesia, and Thailand, South Korea, Philippines, all of them in between that 50 and 90. And that for me personally was a wake-up call that this is the danger of being in a single market, that if I was an Indonesian investor, I would have lost 90% of my net worth in a year's time. And that, I mean, as an aside, was the impetus for First Global to go global. So on the London Stock Exchange in 1999, we were not just the first Indian, we were the first Asian firms to become a member in the next year of the NSD. But that's a story for another time. So this is one that even fast-growing economies can see hiccups. Second, India, while it has been moving up the rank charts, India's market cap is still only less than 4% of the world market cap. So why would you want 100% of your money in what is only 4% of the world? The other important thing, the rupee depreciates over a period of time. When I started my career, when I was 21, the US dollar was 12 rupees. Today it is 83 plus, which means a 85% depreciation in the course of less than a career. So when you're talking long-term financial goals, long-term financial planning, you cannot let go of the sight of the fact that you need to be outside India. Also, depending on the age of the viewer, you or your child may be planning to study abroad, maybe start working abroad, which means that you will be traveling overseas. I see many people now after retirement spending part of the time overseas because the children are there. And which means that you have hard currency expenses. So which means that you should not have all your assets in rupee denominated assets. And as I said, this is not a one-year call. I'm positive on the Indian market for this year. I would even say that India will outperform the globe as we stand here today. But over a period of time, I would suggest that you should move maybe around 20-30% at least of your assets to global markets.
Okay, that's a very important point. So you're saying move 20-30% of your assets to global markets. And you know, children's education by and large is now one of the biggest goals, right? Apart from retirement, biggest financial goals that people talk about. And I take your point, you need to diversify in order to hedge yourself from the depreciating currency as well. So why don't more Indians think global, Devina?
See, Sonia, part of it is that every country has a home country bias. So this is true that every country investors will invest more than what is in a sense necessary in their markets. Canadian investors of their equity money put 60% in Canada. Canada is nowhere close to 60% of the world market cap in equities. But in India, it has become much more skewed because initially, for a very long time, we did not have capital account convertibility. Not just when I was a student, for a long time after I started working also. And some remember a time when you're traveling abroad, also you could take only $20 each time and $500 once in 3 years. So that was the law.
Yeah.
So traditionally, we grew up without thinking that there was this pool available where you could invest, which was outside India, because you could not invest outside India. The only way to get a kind of currency hedge was through gold. And maybe that's part of the reason why Indians are that fond of gold. But other than that, there was no way. But now liberalized remittance scheme has been around for a while and it is pretty generous. It is $250,000 per person per year, which means family of 4 can remit $1 million, which is over 8 crores in a year. So it's like, beyond what anyone would need to invest in most cases. So it is very generous. Remittance also is pretty fast, but the mindset has still not really changed.
Absolutely, absolutely. That is the biggest thing, right? The mindset needs to change. So for all our viewers who have perhaps a large chunk of their money in Indian investments and want to diversify, how do I start my global investing journey? What's the 1, 2, 3 steps that you would advise?
Okay, so now there are 2 ways in which you can, broadly speaking, globally diversify. One is using domestic money. That is not the liberalized remittance scheme, but just your domestic money. You can invest in mutual funds that are partly or wholly investing globally their schemes. Now, the issue with that is, one, I looked at all the mutual funds that have a global mandate. Most of them have a very narrow mandate. So it will be either NASDAQ or US or maybe China or Asia. Hardly any invest globally, truly speaking, across geographies. None of them invest across asset classes, that means fixed income and equity and so on. So your choices are limited when you do that. And there are other 2 things. One is that the expertise to manage global money doesn't lie in India by and large, because the fund managers also have not been exposed to global markets by and large. So what happens is that most of these funds are feeder funds or they are fund of funds. So they're adding a layer of costs here without anything extra being provided to you. You can as well today open a brokerage account for your LRS and buy the same ETFs that they are buying. So that, and also because the funds are not being managed here, there is no accountability. So that's the non-LRS. With the LRS, you can open a brokerage account, you can buy stocks directly, you can buy ETFs or global funds, or you can buy, if you just want to buy NASDAQ, then you can as well buy a NASDAQ ETF without any extra cost. But I would not advise that. So, and the other option is to have actively traded funds or portfolios, which is something, for example, we offer, because this is a cause for me to get Indians to think global, to at least make a start with global diversification. So we have multi-geography, multi-asset funds which start at $10,000, which is just about less than 8.5 lakh rupees. I can tell you that kind of investment is not available for less than $1 million elsewhere in the world. So those are the options broadly, that you can invest through mutual funds, which has its limitations, or you can open an LRS, open a international brokerage account with LRS and use that to directly buy funds, ETFs, stocks, whatever.
Got it. But for people who have zero exposure, just to follow up here, right? I mean, do feeder funds or fund of funds, is it a good option? Because it's at least better than having, I understand you talked about how narrow the approach is and the fact that fund managers here really don't have that kind of exposure to global markets, but it's better than zero, right? So would you advise some of these feeder funds or fund of funds as well?
Actually, the thing, Sonia, is that no asset class, no theme, no geography does well forever. Yeah. So which is why as a policy, as a philosophy, I am against thematic funds. So if you buy NASDAQ, you're exposed only to NASDAQ. So, I mean, for example, a lot of NASDAQ funds came in 2021 and not now. Even at that time, I said, you are looking at the fact that NASDAQ has done so well for 3 years, that's recency bias. Just because it has done well for 3 years doesn't mean it will do well forever. I mean, just to give you a benchmark, in the 2000 tech crash, the NASDAQ high that was made in 2000 was crossed a good 3 years later in 2015. So that's how long a certain geography or a certain type of investment can underperform. So, which is why if you get locked into, let us say, a US index, US and India together are maybe better than India alone, but not by much. I mean, US is still just one more country. So philosophically, strategically, I'm against a single theme, whether it is like in between there were Greater China funds, there were tech funds, and there will be periods when a theme does well. I'm not saying that there won't be. I mean, 2023 is a good example of when only the tech theme did well in large part. But that leadership always changes, which is probably, I mean, what we will be talking about a little later, or, what I mean by that permanent bull market, and which is precisely that the theme changes.
Okay, let's do one thing. Let's take a short commercial break, but don't go anywhere. We'll come back and continue to talk about how you should diversify your portfolio by investing in the global markets, and we'll tell you how to do that in just a bit. Stay tuned. Welcome back. You're still watching Smart Money. Today we're talking about how in a volatile environment that India is in right now, does it make sense to diversify your portfolio by investing in global markets? Devina Mehra of First Global has been with us. Devina, you've done some very interesting analysis on how you can make your portfolio thrive in a permanent bull market. I mean, how do we get to do that? How do we sort of, de-risk our portfolio, so to speak, to all the global volatile moves that we're seeing lately?
Think of the world as a giant wheel. So you have all these cabs in the giant wheel, which are different geographies, different countries, different asset classes, fixed income, commodities, REITs, which is real estate investment trust, equities, and so on. And always when something is going down, something else is going up. You will not always get it 100%, but the aim is to move on to whatever is going to do well now. So, I mean, I'll give you an example. I spoke of the Asian crisis when in 97, 98, in 1 year, so many of the Asian countries saw big crashes, down 50 to 90%. But at the same time, Europe was up 20%. Oil was up. There were always pockets which were doing well. If you look at US tech was taking off. That was the big story of that late 90s, that how the NASDAQ zoomed in those years, the very years that the Asian tigers were doing so badly. If you look at the next phase, which was the tech crash, you still had US treasuries, you had oil, which did well, 20, 25% up. If you look at thereafter, so after the tech crash, so I mean, off late, because barring 2022, since US was doing so well, everybody thought that was the game in town if you wanted to diversify. But 2003 to 2007 was a period when even after the tech crash, US could not come up to anywhere close to its pre-crash highs. Meanwhile, that was the golden period for emerging markets. In that 5 years or so, the emerging market index as a whole went up 3.5 times. India went up 6, 7 times. Brazil went up 10 times. And that was the time when this BRICS acronym was coined. The whole story was that now US is over and it is the decade of India, China, and BRICS. Because the story is always follow what's happening in the market. But as I said, no theme lasts forever. So that also came to an end. And then 2010 onwards, for 10, 11 years, you had this golden period for the US, where the US market was outperforming tremendously. So that keeps changing. And most times you will get some pocket in the world which is doing well. I mean, there are exceptions, like 2022 was somewhat of an exception, where fixed income, equities, almost every region did badly. But that was literally, I mean, not figuratively, it was literally the worst year in 100 years for asset markets. And 2023, again, the recovery came when almost all assets were in the green, just as in 2022 they were.
Just to understand a little more about what happened in the recent decade, right, from 2010 to 2020, and what are the lessons that you would take away from it? What is the expectation over the next 1 decade?
So that was a period, as I said, US did very well. I think the compounding was something like 11.5% in dollar terms. And if you look at India, for instance, that was a whole decade when even in rupee terms, in dollar terms, you had barely any returns. I think something like a 2% or something like that compounding. But even in rupee terms, you did not even compound even 9% for that 2010 to 20. So if you put in 100 rupees in 2010, 10 years later, you would have only 230 rupees. And to give you a contrast, in 1980, if you had put in 100 rupees in 10 years, you would have had 700 rupees. So people say in theory that equity markets are volatile, but they don't really understand how volatile they can be, not just on a 1-2 year basis, but on a whole decade basis. And that is why I said the leadership changes. So if you were invested in the US market in that 2010 to 20 decade, wow, I mean, you would have got greater compounding in dollar than you did even in rupees. So, I mean, in dollar terms, in US market compounded 11.5 and India compounded, I think, 2 or 2.5, something like that. So that's the contrast that can happen even on a decade basis. So that's why I said that diversification is so important when you're looking at long-term financial goals. long-term planning, because
Sure.
long-term planning, looking at only a limited thing, is not good enough.
Absolutely, absolutely. So just, we have a couple of minutes left. Can you leave us with some names, some mutual funds or fund of funds, feeder funds that you think would work well for investors who are sitting here watching you right now, and investors that perhaps want to take part in global financial markets?
I would, I'm, as I said, philosophically against this feeder funds and fund of funds, because most of them are very narrowly focused. And I looked for a fund which is all geography, all assets in India, and I couldn't find any. So then the best thing to do, if you want to invest in a particular geography, is to open your own brokerage account and buy that ETF, which you're going to buy through the fund otherwise. And also, as I said, that we ourselves have a multi-geography, multi-asset product. One is a mutual fund, which is not an Indian mutual fund, but an overseas mutual fund, which is at 100,000 starting. Or you can have a portfolio, which again is multi-geography, multi-asset at 10,000, 8.5 lakh rupees, which is, as I said, normally you will not get for less than $1 million. So those are since no such product existed, we had to invent it.
All right. Devina, we'll let you go on that note, but it was very interesting conversation on how, you should sort of look at diversifying your portfolio, considering that this could be a very tricky year for India, tricky year for the US as well. It's election year, both places. So you never know which way things could head. So shouldn't put all your eggs in one basket, right? Thank you for educating our viewers, and thank you for joining us on the show.
Thanks for having me, Sonia. Great talking to you.
Okay, great speaking to you as well. Have a great weekend. And to all our viewers, thanks for watching. Keep writing to us. We love receiving feedback from you. Until we meet again, have a good weekend.